The last few months of the stock market have been redonkulous. With Americans both dead and alive voting in the showdown between Kamala and the Don, equities markets have shown no chill before or since. Meanwhile, the parts of the world that still use the outdated metric system slapped each other with hot wars along the 34th meridian, sparking fears that things will only get nastier. But in this gambling den we call WallStreetBets, world affairs will just have to take care of themselves, for our mission is that of gains on gains. Ladies and gentlemen, let's crack open that spiked pumpkin spice latte and cannonball into the dankest trades of the autumn. First up in the cockpit is a computer guy by the name of PlayfulDivide126, who joined Reddit on September 12, 2024. Our man's profile suggests that he is a certifiable tech bro who enjoys living life on the edge. And these days, even the most highly compensated brochachos in the tech sector need thick market gains to avoid living in a cardboard box below the interstate. While many Wall Street degenerates have lost their life savings on a certain white powder that makes them feel like Superman, Playful Divide rejected the cocaine lifestyle completely, most likely because he was already taking betaine to help his stool sink lower than an FD lover's portfolio. And according to the internet, mixing Charlie with meds that increase the density of poopage massively increases your risk of heart attack, and that's just not a way to die that your family can explain out loud. Early in his Redditing, Mr. Divider posted to R Overemployed about a J2 interviewer that has friends at his J1 company, which are terms used to describe hiring foreign workers with different kinds of visas. Since he posted to a subreddit specifically dedicated to people who do low-quality work at 2 remote jobs, it's likely his post was relating to finessing some system. But in the background, our man was diligently working, saving up about $110,000 in his Robinhood account, which allegedly took 7 years to achieve. Although he does not share his positions during this phase, his history makes it likely that he was relatively conservative by focusing on blue-chip tech plays. But 7 years to hit $110,000 is a substantial commitment, and with the rest of his money in a 401k, our man wouldn't be able to touch most of his money until he's almost 60. This simply will not do. A man needs gains, and another 7-year slog while inflation eats his buying power is out of the question. He needed bands for popping while he's still young enough to enjoy it. As a techie who works with Snowflake Incorporated, ticker SNOW in his professional setting, Papa Snowman saw this as a real up-and-comer. On Valentine's Day of 2024, Snow had reached a peak of about $236, making momentum traders look at this stock as a serious contender for cloud computing market share. Despite bullishness, our man was hesitant to enter at this high price and waited patiently for his time. That time came in late February when, out of the blue, leadership got shaken up like a fresh margarita. Remaining loyal even though his name would suggest otherwise, Snowflake CEO Frank Slootman resigned from his role as CEO to join Snowflake's board instead. His shift signaled a move from day-to-day leadership to more of an advisory role, focusing on the long-term vision rather than handling operations. Snowflake decided the ad chief that worked at Google, Srindar Ramaswamy, was the guy to replace Slootman as CEO. Ramaswamy had spent 15 years at Google and then left to found a consumer search engine called Neeva to compete with Google, which then got acquired by Snowflake for $185 million. When the big day came, Slootman passed the CEO torch hours before the company's earning call, leaving Papa Swamy to announce piss-poor guidance that rattled investors. Snow was previously growing at a rate of 50% year over year, but in his first announcement ever as CEO, the Swamy stated that growth would likely slow to 27% in 2025. Fickle investors were nettled about leadership's game of musical chairs right before announcing that the company's best days of growth were behind it. The stock tanked 20% after hours immediately, followed by another week of decline. Fortunately, Playful Divide didn't fall into the trap of FOMOing in to buy at all-time highs on Valentine's Day like a noob. Instead, having remained largely liquid through the winter, this huge snowdrop was the opportunity he was waiting for. Although the big Sloot was a chill CEO and this Ramaswamy character's vibe was way off, our man believed a 20% drop was obscene, and the stock was therefore undervalued. Snowman elected to capitalize on this ridiculous market overreaction and purchased multiple call leaps with unspecified strike prices and expiration dates on March 18, 2024, after Snow's avalanche seemed to slow down around $156, a 34% drop from its highs. Snowy was confident that the market would soon see this nasty pullback was without merit, and the stock would bounce with vengeance, sending his long-term calls on a rocket ship. In May, a bearish report from Morningstar revealed that Snow's revenue growth was getting eaten up by higher costs. As analysts began to roll out their assessments, bears were reinvigorated, driving the stock all the way down to $123 by June 25th, then finally $115 on August 6th. Snow was down 56% from its high. Frosty's leaps were melting down, and then it got worse. Papa Buffett sold his entire 6.1 million shares of Snow on August 15th, worth almost $1 billion, predicting an upcoming storm. Although his reasons for selling the stock remain unspecified, it likely had something to do with the company's still very high forward price-to-earnings ratio of 135. Surrounded by all this bearish news, the company's August earnings report was swiftly approaching. For Playful Divide, everything rode on it. His calls appear to have been nearing expiration, and there was little time to prove Papa Buffett wrong. Ahead of Ramaswamy's big earnings call, he held on to his dwindling leaps, praying for a breakout that would turn the tide. On August 21st, bulls made a bit of a comeback, and Snow reached a high of $135. Bullish traders were here to play. Snowman's calls had one last chance to clinch victory, and tomorrow's earnings report on August 22nd was the day that would make or break him. At the closing bell, newly minted CEO Ramaswamy took the mic and popped off. The company showed a 30% year-on-year growth in revenue, exceeding the company's own guidance. Things were looking sharp, and our man's calls were in play. But while 30% revenue growth is solid, it wasn't high enough to offset expenses, and it underperformed analyst demands of 33% growth. Despite signing new contracts and expanding sales to current clients, Snow's share price continued to get pissed on, dropping 13% after hours. Extrinsic value bit the dust. This was the final nail in the coffin, with no hope of recovery left in sight. Everything left on Snowman's calls melted away as the stock stair-stepped down day after day with no evident green to speak of. Playful Divide had worked tirelessly for 7 years to save up more than $100K, and he felt there was no other choice but to cling to these decaying leaps while praying for a miracle. But no salvation came. Feeling betrayed and frustrated, Playful Divide got desperate. In a moment of rage, he sent an email to Ramaswamy, venting his anger and disappointment with some words of criticism. The email wasn't just a cry of frustration, it was a desperate attempt to make sense of the loss, directed at the person he held responsible for his financial downfall. And undoubtedly, the CEO's spam folder saw one more addition to its plethora of junk emails. We must imagine that as the stock continued to flop around like a dead fish, shareholders started to miss old Slootman. But surely this tech bro was adequately diversified in his 401k, right? Not so. His faith in Snowflake was so strong that he held 100% of his retirement account in the company. When people say you should diversify, they mean diversify your holdings, not diversify your account type with the same holding. Snowman lives in denial, just as his account is denied the ability to make more purchases due to a silly little thing called the pattern day trading rule, which apparently can't be bypassed by deleting and reinstalling the app. He still believes that the stock is undervalued and intends to hold his 401k shares for the long term, believing that they will rise by next year. As rationale, he points to Snow's data warehousing market share, believing Snow to be better than Databricks, its competitor. He still has confidence that he can make back the losses by simply applying his trading skills. His plan moving forward is to wait for his bonus to land, deposit it to his account, get over 25k, and get trading unblocked. I have to admit, his dedication to losing money is noteworthy, but even if Snow does rise back up, that $110,000 of calls will forever remain dusted. Moon or bust, we'll see you later, my dude. Now, watch me sponsor myself because I failed to coordinate with an actual sponsor. My fellow WallStreetBets fans, do you trade like shit? Take it from me, it's easier to make money when you don't actually have to risk money. Those of you who follow my Freeloader Challenge know that there are about 30 different websites that you can log into each day to take login bonuses that you can later redeem to your bank account. I'm talking about sweepstakes casinos, but don't let that word throw you. On Sweeps Casinos, you play for free. If you log into these platforms each day, you receive typically between 50 cents and $1 per platform, and across all of them, you can pull in a good $20 to $25 a day without ever putting your money at risk. You never need to deposit anything. And on High Five Casino, you will also receive diamonds, which you can use to play bonus games on slots, potentially netting you huge gains with no risk. This month, I pocketed an extra $240 on Book of 99 free spins by playing diamonds I got from logging in. and as often as I can, I withdraw this money to my Bank of America account with no strings attached. If you haven't seen the Freeloader Challenge, I encourage you to take a look at my most recent video. And we also have an entire Discord community with a free guide on how to do this. Of course, if you are an actual WallStreetBets gambling addict, use your head. If claiming $25 a day for free isn't good enough for you, and you know that you will want to deposit and gamble, go through some reflection. For the rest of you, join me in the Freeloader Challenge and on Discord, and let's start pulling some free money. Be skeptical, but hear my words. I'll see you on the other side, future hustlers. Now, let's get back to the train wreck with dank trade number 4. Rolling in at number 4, we have a user by the name of Epic Sleeping, who joined Reddit on November 23rd, 2021. Epic Sleeping had made less than 10 posts over a span of about 3 years, a pace that might lead people to believe that he was going out and touching grass. But as a committed gamer, it is more likely he was trash-talking noobs and chugging Mountain Dew. His first post was on R Path of Exile, which is some MMORPG. Then he went on to post something called an Eldritch Banish encounter that he had on a Yu-Gi-Oh board. In a pattern of weeb stuff, he talked about a character called Sasuke, which is apparently a RimWorld character rather than Naruto. Continuing his weebish behavior, he crushed several other Japanese MMORPGs in this phase of his life as well. Spending his time on such activities, he appears to have avoided luxuries in order to save money, opting for a cheap Toyota while leaving the finer things in life in his dreams. But several years of this eventually left him wanting. There were no more noobs to smoke. RPG fanfics were getting stale. He was simply growing bored. Cars, women, beaches. He wanted it all, and his journey to the top was bound to be a long one. But Epic Sleeping didn't see the point of grinding for years and years, trading his youth for money so he could get all those creature comforts when he'd be too old to enjoy them. So to reach that penthouse lifestyle, he'd have to hit the ground running. All he needed was to nail some deep out-of-the-money calls on a stock that doubles overnight. WallStreetBets users do it all the time, so surely he could too. All he needed to do was set his crosshairs on the right target. From our man's comment history, we can see that he started by buying $50,000 worth of Intel at $30 a share back in February, and was highly disappointed by its trash performance. He became frustrated by the stock tanking even after releasing what he considered to be good news, that the company was cutting expenses via layoffs. Within our lore, we all know that bag-holding Intel stock would only serve to make Nana more disappointed, and she's been disappointed enough already. This wasn't the right one. If he wanted to change his Toyota for a Lamborghini Urus, he'd have to flip his game to something better. Epic Sleeping went back to the drawing board in late summer, doom-scrolling WallStreetBets until something curious popped up on his radar. Lumen, a relatively obscure telecom company that had fallen off the map, was catching bullish praise. Deals with multiple tech companies gave the stock a fundamental case, and there appeared to be blue skies ahead. But at barely more than $1 a share, the stock must have had underlying problems. Most people would have considered this another case of penny stock copium, but to the big sleeper, there was opportunity if he could time this right, and the gains could be substantial. Lumen announced on August 1st a deal to provide fiber optic cables to some company no one had ever heard of, driving the stock from a low of about $1.30 to $3.30, a nearly 200% increase. Jumping on board was tempting, but the company was also scheduled to report its earnings on August 6th. Due to risk of earnings tomfoolery, our man waited patiently so as not to risk a substantial loss if the penny stock tanked, necessitating multiple shifts behind Wendy's to indemnify himself. Wall Street was bearish on the upcoming results, forecasting a swing to negative EPS versus last year's gain. Lumen went down 20% in anticipation of bad earnings, but in the Snorlax's eyes, this meant the bad news was now priced in. This was the opportunity that Epic Sleeping had been waiting for. On August 5th, when Lumen fell to $2.59, he purchased calls at the $7 strike, expiring December 2025, pouring a whopping $19K on it. He paid as little as $10 each for the calls, indicating sellers found it unlikely Lumen would ever get close to this price. And by the late afternoon, the stock's momentum had already dried up, and call prices tanked to $2 each. 80% of his investment was gone in the course of an afternoon, but Gilf Light CEO Kate Johnson had yet to take the mic on earnings day. All hope was now in her hands, and Kate said, "Let the boys be boys." In a retro move, the quick-thinking CEO said AI 93 times during their earnings call, highlighting how Lumen was a big AI fan. All of the noise about declining business didn't even matter. Kate said the magic word. The following morning on August 7th, Lumen shot up 30%. This led JP Morgan to upgrade the stock from underweight to neutral, while other analysts raised their price targets on the stock. If Lumen was doing AI, then Lumen was a buy. The big man's decision to full fist call options was rewarded. Each of his $7 calls went from $2 a share to about $200, a 100x increase overnight, and 20x increase from his entry. Over the next 2 trading days, he ditched his calls for a gain of about $520,000. Unwilling to completely abandon the stock, believing more upside was just around the corner, he rolled out some of his calls to the $10 strike. So far, those $10 strikes have added another $135,000. In his first serious options play ever, our man achieved what many degenerates dream of but fail to realize. He secured $350,000 completely, letting the other half ride through next December on Fidelity. I have to give him props for cashing out a significant chunk. That $350K is enough for a Lamborghini and 6,000 shares of SEHD. May your gains continue to climb, Snorlax. Now, let's ride into dank trade number 3. Rip walking in next is a man who struggles to solve CAPTCHAs, Robot141, who joined Reddit in mid-2018. Our humanoid's profile suggests that he is a wanderer at heart who wants to live his childhood dream of traveling the world. His first post was in early 2020, showing some Chinese-looking lamp thing shot on an iPhone 11 Pro in ultra-wide specifically. But our man's dreams extended beyond taking pictures of things that looked marginally exotic, and hitchhiking to hostels was not going to satisfy his needs. Fortunately, he was a man of decent means, as he appears to have had about $250,000 invested at the time. But this was January 2020, and we were at the cusp of a major change. During the pandemic, the whole world was thrown into chaos. Lockdowns, riots, toilet paper shortages were becoming the norm, and fear had overtaken the market. But one traveling robot saw an opportunity. Hoping to recreate The Big Short, our guy shorted the market with unspecified positions during March 2020. But Big Daddy Powell would have none of this, and the magic money printer began operating at maximum force. Mr. Roboto got caught with his pants down, and his position was pegged with a $200,000 loss. An L of this magnitude was a gut punch, but the Mad Lad still had $50,000 more to play with, and sought indemnity with savage options plays in the white-hot COVID bubble tech sector. To capitalize on split adjustments from Apple and Tesla, Dr. Robotnik threw all $50,000 plus everything he could borrow on margin into at-the-money calls with short expirations. The market was already self-yeeting uncontrollably. The split announcements energized the massive retail buyers who joined the frenzy during this era, and the icing on the cake, Elon Muskrat casually tweeted a $1,200 price target on Tesla. This perfect triad sent our man's $50,000 portfolio to a grand total of $1.2 million by September. He celebrated by purchasing a house for his aging parents, a Tesla for himself, and a surrogate, which I assume is a reference to getting his side piece knocked up, just like Elon. After clawing his way back from a sub $50,000 portfolio, his comeback was one to be applauded, for he proved that with the right memes, the right calls, and some serious cojones, an early retirement is possible. All of this is great, except for one minor detail. This wasn't the end of his training journey. It was just the beginning. Emboldened by his over $1 million of gains, our motivated clanker was determined to make his wealth generational. After giving Uncle Sam a distribution and buying a house for his parents in cash, the big shot had about $600K left in play. If he could just double up, he'd be set for a lifetime. With stonks mooning left, right, and center, the big dog dropped all $600K on SPY and Tesla calls, assured that victory was ahead. But you know what they say about September? It'll make you its bitch. As profit-taking took hold in the market, Tesla started to dip, but bailing with a loss was unacceptable, and our man knew that sweet gains were still on the way. Meanwhile, the standard September pullback was burrowing into the index, and SPY started sliding as well. As the days went on, our man's calls on SPY and Tesla disintegrated at a parabolic pace. With diamond hands, he held on with an unshakable grip, confident that the market would rally with vengeance. But he was wrong, and the robot was left shafted and zeroed. All $600K was gone. Although he had bought the house for his parents, credit to him, his liquidity was shattered. Losing everything due to his greed was humiliating. Feeling dejected, our man took a hiatus and stopped posting on WallStreetBets for more than 3 years, opting instead to post about some computer and video game stuff. We must imagine him at the house he bought for his parents, playing PS4, wondering why this relatively comfortable lifestyle wasn't all it was cracked up to be. This was not the outcome he craved. The robot wanted to be out exploring, not wearing golden handcuffs at home. As time went on and his wounds started to heal, the aspiring nomad decided to get back on the horse. In August 2024, our cyborg dusted off the cobwebs and challenged fate for a new destiny. Cracking open a bottle of engine oil, Papa Robot assessed market conditions and determined that stonks were in an unrelenting uptrend. Short-term swings were substantial, and an aggressive trader could print stacks with the right timing. Summoning his options experience from 2020, the big man went balls deep, fresh out of the gate, putting his $28,000 of liquidity back in action. By flexing short-term calls with some targeted entries, the resurgent trader nailed multiple back-to-back wins on SPY calls, and then flipped to puts when the market seemed too hot. By leveraging margin, he was able to make much larger trades than he had any business attempting. But the stars aligned, and the big homie's portfolio more than 10x'd to over $315,000, representing a gain of $281,000 in less than a month. After his years of lying in wait, his return was one that defied the odds, and now he was well on his way. All he'd have to do is do it again. In late August, SPY was trading for just over $560. After being up almost 20% on the year, Wally determined that the market was too hot and needed to chill out. But having cold feet himself, he did not commit to another trade until SPY had dipped $15 to about $545. On Friday, September 6th, the cyborg finally decided to strike. In the early morning, the big bear full ported plus margin into hundreds of puts at the 543 and 548 strikes. With SPY dropping as fast as it was over the entire week, R2D2 expected a quick in and out to crank up the gains. And with buyers continuing to flop around flaccid, bears were indeed in control throughout the morning, driving the price down about $5 to $540 by 12:15. While a 1 to 2% drop may be nothing to long-term investors, this drop is Lambo money for leveraged FD traders. With remarkable precision, our homie closed his bucket load of puts for a profit of over $100,000 within a matter of 3 hours. To really put that into perspective, he made $100,000 in the time it would take to watch Wolf of Wall Street. To mark his achievement and honor his love for Britney Spears, our man displayed his pride and joy on WallStreetBets. He reassured the community that he closed his options to buy shares of Berkshire Hathaway, which for some reason he believes will give him a 4 to 5% return that he can then use to pay taxes in a few months. It is not clear why he believes BRKB is a better way to get 4% return than a high-yield savings account. Nonetheless, our cyborg intends to only take his foot off the gas slightly as he continues his push to 1 million. As other Redditors began to share memes of Intel Granny, the nomadic bot was happy to accept the love and adoration as she looked down on him from above. But adoring fans are likely too rosy, as I suspect his account is once again curb stomped. The Monday after preaching his $1 million goal, the robot indicated he bought SPY 450 puts expiring on October 19th, which expired worthless. It is unclear if he sold prior, but the fact that he stopped posting on WallStreetBets and now posts on pop culture subs shows me what we all fear. Chances are, our man has once again been put through the grinder. I hope he returns to prove me wrong, but at this point, I am pretty confident that Robot's trip up the mountain got cut short once again. I hope I'm wrong, C3PO. Now, let's move on to dank trade number 2. Next up is an individual who clearly takes OPSEC very seriously. Axeman from MA is a 27-year-old man living with his parents in Boston, where he makes $85,000 a year as a business development representative. He also has large hands, making car repair difficult. Having joined Reddit on August 9th, 2020, our guy was deep in the stonk talk from the very beginning. His first post in late 2021 was about how SPY was going to moon because of a new wave of COVID, which would cause another summer 2020 lockdown rally. Because this thesis is breathing with your mouth wide open levels of dumb, Axe's DD drew backlash from another Redditor by the name of Regarding Your Cat, who tore apart our man's thesis. According to the cat, there would be no rally because the Fed was boxed in, having used all the tools at their disposal. Axeboy counterdunked by sharing his modest position in SPY calls, which was green by $100. The cat told him this is weak sauce, and he should ditch now. But the advice fell on deaf ears, and Axeman believed an illegally propped up post-COVID rally part 2 was all but assured. At the time of this exchange, SPY was within 2 weeks of the COVID bubble's top, after which the market went into a 10-month decline, so congratulations to Axeman for timing the top with precision. 3 days later, on December 19th, 2021, he posted his DD on R Investing. Like an astrologer, he looked at how SPY's relative strength index tended to stay above 30 during an uptrend and frequently capped at 70 during a bull run. Meanwhile, SPY's RSI stayed 30 or under during a downtrend. It's clear that Axeman is a market novice, since this technical analysis has about as much depth as a Mario Party minigame. He later expanded his thesis across the Atlantic, explaining how the UK's recent market decline would also reverse course, since it was a hotspot for the new COVID variant. As COVID equals market rally, he believed the British would print gains as well. This did not happen, and as another helpful Redditor pointed out, this level of janky DD had cost our man $15,000 in the past, and he appeared set to continue losing. A week later, while cruising some stonk app, Axe came across an article which talked about the S&P 500 being due for a correction. Naturally, he became even more bullish, reasoning that if everyone was predicting a slowdown, the opposite must surely be true. Confident in his contrarian status, he posted another screenshot of his Robinhood account, now up a staggering 125%, with his portfolio hitting a cool 3,600. This was the first step in a long journey, but he was only at the cusp. Victory, it seemed, was within reach. He envisioned Lambos, private jets, and the sweet smell of success just around the corner. Over the next several years, we see from Axeman a deeper and deeper dive down the rabbit hole of gambling addiction, retroactively supported by garbage DD. He continually, month after month, deposited his paycheck into FDs. His strikes were often so far out of the money that sellers were probably happy just to have a buyer. Time and time again, he was cooked. In one instance, he managed to lose almost $23,000 without ever seeing a green day, leaving his portfolio back down to $26.54. Then he would deposit more paychecks and lose it all again. And again, and again. His victories were limited to taking funny screen caps of SPY prices. That's when we discovered that he was living rent-free at his parents' house, using most of his money to fuel his gambling addiction, digging into savings when paychecks weren't enough. Other users started calling this what it was, a crippling gambling addiction that grew worse as Axeman mooched off his parents' generosity. We see his obsession fully manifest as he blames West Virginia Senator Joe Manchin and unspecified short sellers when his 20% out of the money 7-day to expiration SPY calls did not print. With nothing left to lose, Axeman risked his last Benjamin on deep out of the money SPY calls expiring 3 weeks later as he ranted about short sellers and failed to deliver shares just like a GameStop lunatic. Of course, this too failed, and the addict was stuck on the sidelines until his next paycheck, which he dumped into more SPY calls. Following some more technical DD, the Axe predicted Shrek boners on the SPY chart, but once again came up flaccid. Our guy, who continuously dumped paychecks into failed options trades and burned through much of his savings, was reduced to asking his mom for permission to buy $5,000 worth of shares to hold. Sick of her son's gambling addiction, she pulled a Robinhood and restricted him from trading, telling him to save instead. Reluctantly, he said yes, but elaborated that he meant he would save by holding shares of 3x leveraged NASDAQ ETF TQQQ. The final message we see is of his mom telling him not to buy any shares. But Axeman was no mama's boy, and he returned to trading immediately, predicting market makers would soon be working at Wendy's, demonstrating he doesn't even know what a market maker is. His mom saw him balling away on Robinhood and Vanguard and messaged him to stop. Apparently, the problem became so serious, his mom wanted his dad to join in on Axeman's next therapist appointment. Her words fell on deaf ears as he showed his solid DD, remaining headstrong that he wasn't gambling, but simply being a businessman doing business. Now, in all seriousness, if your investing skill is so bad that your mom is telling you to stop, then you should listen. But listening comprehension was not among the man-child's power-ups. In May 2022, Axeboy claimed the algos were shorting away SPY to no end, relying on his magic crayons once again. His assessment showed an empty wick piercing deep to the downside, allegedly demonstrating that unspecified market makers are executing a short ladder attack on SPY. His plan was to YOLO his money once SPY falls to the 365 to 370 range, correlating with the bottom of the empty wick. Buying at previous support levels is a valid approach, but the fact that he is blaming market makers for short ladder attacks, demonstrating that he doesn't know what either of those things are. I can't not say this. Market maker is not another name for hedge fund. A short series of one-off posts followed that summer in which Axe saved some employment paychecks. As he recharged his batteries, our man lamented the difficulty of finding a serious girlfriend and to pivot from WallStreetBets to SmallStreetBets for his DD posts, as he no longer had adequate position size to post on the mothership sub. Back in the game in July, the big homie tried to mix up his approach as he sold covered calls on TQQQ, the 3x leveraged NASDAQ ETF, and got assigned shortly after. He lamented the missed profits. Although when you're down tens of thousands, I admit it's hard to get excited about a $3,000 profit. But luck would favor him. Pivoting into meme stock Bed Bath & Beyond, a frantic pump brought him $10,000 of long-awaited gains, taking his portfolio to over $38,000. He followed up by losing $6,000 on AMC. Still green on this most recent run, Axeboy recognized that a JPOW speech in late August presented an opportunity to fully indemnify him if he could only anticipate what direction the market would take. JPOW at Jackson Hole could be a seminal event, and he needed to take advantage. With about $25,000 of liquidity, this was the moment he was waiting for. But in an act of humility, he finally recognized that his DD was consistently shit. He had no choice but to elect a position based on the decision of someone smarter than him, his dog.
Break.
With Fido's decision in hand, Axeman charged ahead and bought spy calls with every speck of money he could summon. The big speech sent shivers through the market as JPOW got more hawkish than a Mongolian falconer. As the market opened the following day, SPY dove down 1% at the bell, grinding the $27,000 worth of calls into powder. Once again, Axeman was zeroed out with no prospect of recovery. Even his dog was disappointed in him for letting an illiterate animal choose how to bet 27 grand. We don't know if his mother ever found out about this. His losses began to make him concerned about his physical well-being, prompting him to post a picture of his hair in the sink on our hair loss. If you're that worried about your health after seeing a few strands of hair getting pulled out by a comb, you need to reflect on your lifestyle because you need help. After Redditors alleviated his concerns of potential hair loss, our guy went on to buy Shiba Inu for 0.000026, planning to hold it until it hit 5 cents, so that his $700 position would become a cool million. Since Shiba Inu currently has a market cap of 10 billion, a 5-cent price target would imply a market cap of 29 trillion, making it more than 20 times as expensive as Bitcoin, more than 7 times as expensive as Apple, and surpassing US GDP. That's all it would take to get Axeman back on track. We don't quite know where that play went, but he must have jumped back into options. The next time we see him, he posted an update to his all-time chart. The line rolled off a cliff, did a sharp uptick on Bed Bath & Beyond, followed by the oblivion of a 97% loss, bringing his portfolio down to sub 2K. He lost a grand total of almost $52,000 while staying at his parents'. And that's just on Robinhood. We know Vanguard was at least equally bad. Manifesting his comeback story, he magnified his bullishness on SHIB, tripling his price prediction to 15 cents, representing most of Earth's liquid assets in circulation. He also took some additional passes at predicting the S&P, but they amounted to nothing but loss. In September 2024, Axeman picked up the ball for one more drive, and I do admit, his update has me eating my words. I have to take back what I said about him driving his portfolio into oblivion. I had underestimated the true depths of his degeneracy, as he wasted his portfolio down to $25.43 in net worth. His screenshot still showed a SPY call expiring that Tuesday, but his total return amounted to $2 before that too disappeared. Whatever delusion he had about making life-changing gains with his very next move, his addiction resulted in nothing but permanent loss. He has $25 in his Robinhood account and other unspecified losses in Vanguard, which we will never see, but his mother revealed that they're at least equally bad. Gambling addiction turned 4.5 productive years into the same value as if he were doing nothing but turning beer into piss in his mother's basement. Thanks to a recent update from Axeman, we learned that he actually did move out, probably not entirely on his terms. His continual losses almost certainly got him kicked out. Temporarily, that is. Apparently $75,000 a year was not enough for him to live in Boston and support his gambling addiction, so he had to move back in with his reluctant parents. One day, I kind of hope this young buck does make a nice million on some lucky FDs, because his mom and dad deserve to be naked in their own house, and having a 27-year-old gambling addict digging through your refrigerator is certainly a huge turnoff. Just as much as Axeman is a victim of gambling addiction, his parents suffer for it too. Give your mom a hug, Axeman, she needs it. Now, the moment we've waited for, our dankest trade of the autumn. A wise man once said that jealousy is the truest cause of people doing the dumb, and it is through envy of another that many a man has wrecked himself. But this philosophy has opposition. Some are fueled by the desire to rise up and surpass their ops, thereby becoming heroes in their own story. In 2018, a well-to-do man named LoudPoem362 observed dank trades on WallStreetBets and reflected on his own life in comparison. Netizens of our favorite sub were niche in these old days, before the GameStop madness put us in the limelight. LoudPoem observed an unspecified post in which a mad lad made $500,000 by trading CHGG. Chegg is a company that manages digital textbooks and online tutoring, which is a useless product in 2024. But back in the old days, Chegg was promising, and its traders saw substantial gains. Our man believed that if he could identify a similar up-and-coming company, that he too could self-recuse from the tribulations of the middle class. All he needed was to move his pieces just right. In late September 2019, the Loud Poet saw the perfect opportunity. Rather than identify a rising company, another opportunity presented itself. That week, Nancy Pelosi started live streaming and the chat filled up. In one breath, she announced that President Cheeto done goofed and would be henceforth impeached with prejudice. Loud Poem, who slept through civics class, believed impeachment meant that the president would be removed from office without delay. At a flick of Nancy's wrist, Trump would be physically removed from the White House by the Sergeant at Arms, and further deliberations would determine the new president. This was the opportunity our man had been waiting for. Removal of a president is literally unprecedented. There was no doubt that Nancy had just caused a tremendous political upheaval and constitutional crisis. The stock market was virtually guaranteed to experience extreme volatility in response. Loud Poem knew exactly what to do. With his entire payload of $70,000, he full ported into an unspecified volatility ETF, most likely VXX. As market volatility shoots up as a result of the constitutional chaos, VXX would moon, printing massive bags. Over the next few days, VXX pushed up just a tiny bit before it became apparent that Congress would not have the votes to remove Mango from office. There would therefore be no change in executive leadership. Market volatility started to immediately tank, and VXX dropped bigly. Our man was confused. Did Congress rug Nancy's decision? Did Trump play Uno reverse? How do you unimpeach? A simple Google would have solved this misunderstanding before Loud Poem lost 50% in the course of a week, but his civil inexpertise had cost him big right out of the gate. Frustrated by this misstep, but now more educated on civics, our man pressed on with his shrunken portfolio. Later in 2019 into very early 2020, the rising trader evaluated world economics and determined the market was due to moon. President Cheeto had just signed a Phase 1 trade deal with Emperor Lu Bu of China, and NAFTA was replaced with the generic named USMCA trade deal. The world market was firing on all cylinders, with nowhere to go but up. Buying long calls was a hands-down decision. And we all remember what happened next. In late January, the US got its first taste of coronavirus. Panic set in, driving market volatility to obscene levels as the major indices started hitting circuit breaker level drops. If he had still held VXX, he'd be cooking. But holding long calls during the early stages of the COVID crash was not the spot. Before it could get worse, our frustrated friend bailed nice and early, losing only another 50%, leaving him with about 15,000 left. If he had held his calls longer, they'd have been dusted. Refusal to diamond hands allowed him to preserve what he could, which he promptly withdrew. Between late September and early January, the overzealous trader had burned about 55 grand, representing the majority of his net worth. With the remainder of his money on the sidelines, Papa LP watched as the market surged in the lockdown bubble that followed. His blood was boiling. He had bought and sold VXX too early. Then he bought and sold SPY calls too early. If he had just bought VXX or SPY later than he did, he'd be 2 for 2 with huge W's. But now he was boxed out and humiliated. This could not end well for him. He needed to regroup, replenish his funds, and then get back in the game. By autumn 2021, the poet had saved up some dough and was prepared to get back into the market with 40 grand. During those bubble days, hot tech stocks like Tesla were a shoe-in for thick gains. It is easy to forget just how simple it was to make 3-digit percentage gains through most of 2021. You could simply pick a tech stock out of a hat and buy calls on it, and await 200% gains. And with his $40,000 of Tesla calls, our Voltaire was soon looking at $75,000. Although not fully indemnified, he was well on his way, and now he had discovered just how easy investing could be. All he'd need to do is do it again. After finishing up with Tesla at some point in late autumn, the poet reflected on his next move and determined that BlackBerry, ticker BB, was due for a long leg up. BlackBerry has a storied history as a classic dot-com bubble stock with a short-lived spike during the early smartphone days. But in 2021, it first rode the coattails of GameStop during the sneeze, and then developed a small cult of its own throughout the year, leading to several large bumps in price. If one looks at the very long-term chart, he might expect that the bottom was somewhere in 2017-ish, and the stock was due to recover to early smartphone era levels. Loud Poem, expecting the price rise to manifest once again within the next couple of years, opted to blow his whole load into deep out-of-the-money calls expiring in 2022 and 23. All 75K was on the table, and with a boatload of calls, all he needed was for a nice spike to cash out massively. But the berry bush was unkind. Despite diamond hands, the 2022 bear market, and the fact that BlackBerry is just not a good stock, led to a cratering of share price all year. Our poet lost everything. Virtually 100% of his position was dusted. Once again on the sidelines, Loud Poem assumed his position in the cuck chair to watch other traders on WallStreetBets post their massive gains. Throughout all of 2023, his eyes glazed over as he saw, day after day, traders posting their huge W's in a powerful bull market. He had by now invested a total of $115,000, but had nothing to show for it. If he had held that in indexed ETFs, he'd instead be well over 200 grand at this point. The frustration was relentless, and he could not bear it. He needed to get back in the game. As the siren song of the market, amplified by WallStreetBets, serenaded him into submission, Loud Poem reflected on what assets he could commit to the market for a third attempt. His personal savings was already empty. It would take months of paychecks to recover, and indeed he did start making deposits when he could, but it would take time. In the immediate term, this left only one asset at the ready, an old employer's 401k at Vanguard, split between Roth and traditional accounts, which collectively held approximately $50,000 of diversified assets. He could play it safe and let it compound. Or he could roll it into a self-directed IRA and test fate for a third time. The choice was obvious. Both 401k accounts were at Vanguard. He decided to roll his traditional 401k into a self-directed IRA at Vanguard, while he rolled his smaller Roth account into Robinhood, most likely to collect that sweet deposit match and ease the user experience of trading options. When his account settled, it was off to the races. This 50k, his lifeline, was to be employed in something more ambitious than Vanguard ETFs. His first major play of 2024 was on Meta. According to Redditors, Meta was ramping up hiring in early 2024, indicating Zuck anticipated good things ahead. To take advantage of Meta's expansion, LP bought call debit spreads on February 1st for about $4,300 and a long call expiring on January 17, 2025 for about $10,000. The very next day, Zuck spat amazing news into the mic that Meta would run a share buyback and pay a dividend. Shareholders were dazzled, and the stock moved 20%. For the poet, this translated into a profit of almost $12,000. Coming off this W, which was in fact his first substantial win since Tesla 2021, he turned his attention to Spotify, which was due to announce earnings. With Spot taking over the music streaming industry, calls were an obvious move. By going in on calls at the $250 strike, he was positioned for a $3,700 gain when Spot announced it had better subscriber numbers than anticipated. He then read a bearish post on a drug company called Amgen, authored by a user on WallStreetBets. He was convinced that Amgen would lose ground to Eli Lilly and expected regulatory pushback on Amgen specifically. Hence, he targeted Amgen by purchasing $2,500 of puts ahead of earnings. During the call, Investors were not amused by the CEO's weak responses about drug testing, and the stock took a fat dip. Loud Poem had doubled his money. These small gains were all well and good, but he needed volume, and $3,000 gains at a time would not do. He needed to ramp it up, or he'd be forever destitute. Still in February, the poet turned around and took sight of the semiconductor industry. In England, with AI emerging as this bull market's hotness, our man expected British chip company ARM Holdings to post great earnings. Accordingly, he ramped up his game and placed $16,000 into leaps ahead of the big earnings announcement. When oddly American CEO Rene Haas took the mic and said AI a few dozen times, the stock began liftoff. The big jump pushed him to almost $40,000 of profit, a respectable sum. But the rising star lamented that if he had held his leaps longer, he'd be at about $100,000 profit. Why he sold so soon is unclear, but this desire for even larger wins pushed him farther, harder, deeper. What transpires next is an impressive series of remarkably well-executed trades that contrast sharply with his garbage trading years prior. In 2019, he didn't know what an impeachment was, but in 2024, he was evaluating company profitability based on fundamental analysis, and the more deliberate trading was paying off. Or maybe he was just getting lucky. Either way, his portfolio continued to climb. In early March, he flipped a $6,700 earnings play on Dell for a profit of $30,000. Then he doubled a $10,000 trade on SPY puts shortly after. Loud Poem continued his march by then ramming $5,000 into short-term Foot Locker puts, expecting the shoe industry to put up weaker holiday numbers than in years prior. When Foot Locker presented its earnings, investors were appalled at the lack of comparable store sales, whatever that means, and the stock tanked, doubling our man's investment once again. Since the shoe industry was apparently shitting the bed all quarter, our man made a high IQ move by buying puts on another shoe company prepared to announce earnings, Nike. Nike's shares likewise slid due to bad sales in China and reduced efficiency in sweatshops due to humanitarian regulations. The stock price dipped down, giving our man a payday of $15,000. He would later post similar gains on Nvidia and Hewlett-Packard, each time taking wins based on at least relatively calculated approaches. Even when the market decided to turn against him one morning, he swapped his position and still finished the day with a $9,000 gain. According to the stock market madness without so much as a hangover, Loud Poem 362 bought Dell Leaps expiring in January 2025, paying a premium of $127,000 total, a sharp increase from his previous plebeian level investments. With CEOs spitting sick AI bars at each earnings announcement, the poet anticipated that Dell would likewise get that extra fuel, and for this aggressive trade, he was rewarded. The big man himself, Michael Dell, said the magic word enough times during the earnings call, and his company hit a new high. Our man's leaps left the atmosphere, carrying his position to approximately $295,000. But life cannot be made too easy. Ahead of the Paris Olympics, our poet expected travel company Experian to put up big numbers, apparently not believing that the Olympics travel was already priced in. This was some of his worst DD ever, and he paid for it with a $25,000 loss. But he began to feel numb to the big numbers, as he remained dead set on his sort of target, an unspecified amount of wealth. His occasional losses were indeed a setback, but his gains now put him over $600K. The big 2 comma club started looking not only nice, but realistic. The classic price target was in his crosshairs, and now it was time to execute. He turned his sights to the next prize. By late July, Nike had been stomped down by low productivity from child workers and decreased demand for products, and he had made money off of this prior, but losing 30% year to date was unwarranted. This massive drop on stock price presented an opportunity to grab calls while shares were under $75. Through the end of the summer, the overseers worked out the kinks in their production chain, and Nike began to bounce back. By the time our man sold, he was walking out with a gain of $166,000, more than most Bangladeshi child workers will earn in 664,000 hours, or about 75 years, a significant achievement by any standard. But he wasn't done yet. Throughout the summer, Reddit stock had fallen largely out of favor, and much of its spring gains were dissolved. Loud Poem determined that Reddit was only growing in popularity, and highly regarded users were constantly gilding each other for no reason, giving real money to Reddit in exchange for digital awards. The stock was undervalued. He picked up an unspecified position close to the bottom in August and rode the wave back up to 70 for a $73,000 gain. Then, in possibly his most boring play of the run, he dipped his feet into ASTS as the stock soared on news that its satellites were working, netting him a $100,000 gain. His portfolio was at the cusp. He needed just one more big win to hit his goal and establish a lifetime of wealth. It was time to nut up or shut up. In September, the big man evaluated Nvidia's dip. Investors were allegedly becoming razzled by the fact that the company was reaching capacity, and growth would be slowed down by the fact that Nvidia simply could not service more clients. Coupled with China's saber rattling over Taiwan, again, investors were cashing out ahead of potential trouble. Further, CEO Jensen Huang was selling shares, but Voltaire was not convinced. As far as he could tell, profit takers were overreacting to marginally bad news about uncertainty, and Nvidia was so well positioned in the chip sector that every dip was a buying opportunity. With boldness, he threw his lot into calls, buying just as bulls began to capitulate. The stock dipped to 102 and things were backsliding. His position was teetering. If Nvidia fell any further, he would be crushed. But CEO Jensen had his back. By late September, Jensen announced his days of selling shares were over. Bain Capital predicted unprecedented demand for Nvidia-associated data centers over the next few years, which doesn't sound like news to me, but someone liked it. Or perhaps the most mundane explanation: that loud poem was right. Nvidia is, and always will be, the king of chips. In the span of a few weeks, Nvidia climbed 20%. All of our heroes' temporary losses were absolved, and $166,000 of gains were in the bag. Our champion had done it. In the course of a year, Loud Poem 362 had pushed his last $50,000 to a death-defying $1,032,000. And even better, as these gains were all in an IRA, he would owe no taxes on this huge increase. He eagerly showed the numbers to his wife, who mistakenly thought the $1 million was a projected retirement amount. He didn't bother correcting her, which is an extremely smart move. You should never tell your wife or kids that you have money. The freshly printed millionaire resolved to do the smartest thing possible. He would put the vast majority of his holdings into stable, indexed ETFs, and over time, this million would compound even further. By the time he can retire, his portfolio would likely be worth over $4 million, or in 30 years, $8 million, enough to live off of for the rest of his life and still give his kids more than he ever had. Although so many WallStreetBets traders submit to greed, we finally see someone who knows how to handle a win. In honor of this heroism, including one of the wisest exits in WallStreetBets history, we recognize the astonishing rise of Loud Poem 362. Your humble beginnings in losing money for not knowing what an impeachment is, to printing money in a striking pattern of calculated wins, is a journey worthy of the utmost admiration. It is my honor to bestow upon you the coveted crown of kings. May you wear it well.
Who wants to be king?
Thank you all for watching. Make sure to subscribe so you don't miss the action, and I'll see you next time.